Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Sales International Limited. And here is your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar. Since the V-bottom pattern formed over March and April, the market has risen. However, 2 weeks ago prices seemed to peak out and then head back down for a bit. I'm not sure if it was the 21st century 50% absolute Fibonacci line at 1809 or the approach to the middle time that was then nearby, currently at 1855, of the December 2020 to April 2021 Andrews pitchfork. This is an untested pitchfork, so it may be taken cautiously. Anyway, it could even be the combination of both of them. The result was we saw prices peak and drop off down to the previously highlighted congestion between 1630 and 1680, where they stabilized. Later on last week we saw a revived attempt higher, but again prices seemed to peak only a little lower. There does seem to be some hesitation around these levels between the congestion 1630-1680 below on one hand and the 21st century 50% absolute Fibonacci line on the other. It is a wide area, but it has for the most part been effectively worked. The market today has, however, decided to try and upset this indecision. It hasn't done it yet, but it seems to be trying to form a key reversal down as prices rest upon the very recent lesser Fibonacci level at 1731. Overall, the market still seems well supported, with not only the congestion at 1630-1680, but also the medium moving average currently at 1613, the lower time currently 1577, the April 2020 to date uptrend currently 15.25, and of course the long moving average currently at 1489. The only question is this: is the action over the last 2 weeks a type of halfway hesitation, maybe leading to a measured move higher, or is it a nascent double top? I'm just not sure as yet. Nice Europe white sugar. Once again, compared to the New York contract, this one in London continues to be different. Primarily the April to July 2020 bullish shift pitchfork has worked and continues to work. Please don't get me wrong, it has been broken back at the turn of March into April, but has seemingly repaired itself enough to function and still seem important. The market's repair was enough that 4 weeks ago we had a weekly key reversal up. However, that was neutralized 2 weeks ago with a weekly key reversal down, which there was no follow through lower last week or this. So, indeed, last week and late this week and late the week before, the rising medium moving average halted the decline. That's currently at, where are we? 448.5. It stabilized prices, starting a slow move back up. The top side now has 3 levels to look at. The May 2017 high at 469, the original middle time currently at 478.30, and the newer middle time currently at 487.5. These are separating and will diminish in strength over time because of that, but right now they are still potent, as can be seen when the high of the weekly key reversal down 2 weeks ago capped the rise. These strong forces are still fairly set apart, which is why a move such as last month's outside month could have happened. It may be even that the bullish incentive is undergoing change. We could, for example, have a February to April bearish shift pitchfork as well, the first real bearish pitchfork I have drawn here for a while. I have left this on the daily chart just to give an idea that the forces involved are creating new patterns, and not all of them bullish, as has been the case since the drawing of the April to July 2020 bullish pitchfork. If we're going to go through a change in sentiment here, then there is some serious examination of the bullish incentive underway. Weekly sugar white premium. Now, the recent move lower started 7 weeks ago, with a combined outside week and bearish engulfing pattern. Since then, prices have disposed of the November 2019 to November 2020 bullish shift pitchfork, as well as closing below all the moving averages. The 50% Fibonacci on the big July 2019 to May 2020 move at 80.25 as well, and last week challenging the neckline currently at 75 even of the 2020 head and shoulders top. Well, head and shoulders pattern I should say, it's not top yet. The pressure low has seemingly been alleviated by the congestion from September last year till the end of this year between the 50% Fibonacci line and the neckline, but will it hold? If it does, and we have a move back up that fails at a lower level than the February high, then we could have the makings of a possible descending triangle. However, it is way too early to look at that just yet, and it relies on many complex actions working together. One final thought. We are possibly on the verge, in the next week or so, of having a bow tie formation of the short medium moving average, currently at 92.25, the medium moving average, currently at 91.5, and the long moving average, currently 91.25. This is not a done deal yet, but it looks as if it might be, and a bearish one as well. The only issue is that the moving averages are all in the wrong order, so keep a close eye on that, just in case it happens. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.